Hello and welcome back to Perfect Spiral Capital. My name is Luke Tatum. I'm an authorized infinite banking concept practitioner, and today I want to talk to you about the worst case scenario. What if I can't pay my premium on my whole life policy? Are you totally out of luck? What options do you have? Well, let's get into it. So let's say that you've signed up for a reasonably large premium of $10,000 per year. Now, if you've signed up for that kind of a policy through Perfect Spiral Capital, one of our team, it's very likely, depending on your unique circumstances, that not 100% of that $10,000 premium is going to be mandatory to keep your policy in force. Some of that premium is going to be what's called paid up additions. Plenty of other videos on the channel talking about what PUAs are, so I'll skip that here for now. However, that would be the first place to start. Okay, can I reduce how much of this $10,000 I actually have to pay in order to keep the policy in force? In all likelihood, yes. Let's reduce that. Let's say that you've got a pretty conservative policy design in terms of how many PUAs you are. You're looking with an eye towards really long-term dividends, retirement income, that sort of thing. And so let's just say, to make this video straightforward, that you have 50% base policy, in other words, it's mandatory, and 50% PUAs. So $5,000 instead of $10,000. Just see if you can reduce your PUAs or eliminate them. And let's just say, for the sake of argument, you're not going to pay any PUAs this year. Okay, so $5,000 premium, $5,000 PUA, you've eliminated that. So your total obligation is $5,000. Okay, well, that helps, right? You may be able to reduce your out-of-pocket expense for the year by more than 50%. Again, it's just an example. And it depends on your unique situation. Your policy design is unique to you based on the discussion that you have with your qualified professional agent. That's why it's important to find someone who's qualified. Okay, the next question would be, how long have you had this insurance policy? If you've made one payment, you made a $10,000 premium, and now we're in year 2, your first renewal is due, well, reducing your PUA premium is probably your best option to start, as we just addressed. If you still can't quite do it, your dividend is likely not that large at that point, and so your dividend is not going to be large enough to cover your entire premium. It probably will at some point be large enough to cover your entire premium, but if you're early on in the policy, it's not going to be there just yet. You can still switch your dividend election. We have a recent video talking about the 5 different dividend elections or dividend options. One of them is to have your dividend reduce your premium. Let's say, again, worst case scenario, it's year 2 of the policy. Let's say you have a $500 dividend. Okay, your $500 dividend pays $500 of the $5,000 that you owe. So now your due premium is $4,500. We've taken a couple of steps to reduce what's due. $4,500 is still too much. Okay, now what? If you're working with someone who has designed what you might call an infinite banking policy, there's likely a good portion of cash value available in this policy now. Can you tap into that? Well, you might even have $4,500 of cash value if you've got a 50-50 policy design like that. Let's just say that you do. Okay, you take a policy loan, $4,500. They send you a check or direct deposit into your bank, they being the insurance company, and then the money's available, you pay your premium. You now have an outstanding policy loan. The great thing about policy loans is they don't have a due date. You can take all the time that you need to repay that. Encourage you to just pay what you can to keep the interest from from growing year after year. But if you're in a really tough spot, just forget about it. Take the policy loan, pay the premium, get back to your normal life and try to get on a better financial standing. If you just lost your job, don't worry about the policy loan. Just don't worry about it. Pay it when you can. And so there you go. You've eliminated that big bill by taking a few steps to control what's happening. Maybe you have enough cash value that you didn't have to switch your dividend election. Maybe you have enough cash value that could cover your base premium, and you still have a little bit of money that you find to pay some PUAs. So maybe instead of $5,000, it was $6,000. Your situation's going to be different. With our carriers that we use here at Perfect Spiral Capital, your PUAs are not all due at the beginning of each policy year. So you could certainly do that. You could figure out how to manage this cash flow crunch and then come back and say, you know what, I think I can afford to put some PUAs in. And you do. And that's great. Do it. It grows your cash value. It compounds for the rest of your life. It's all wonderful. But what about if you've had this policy for even longer? And this is kind of a last resort, okay? Let's say you have had your policy for 10 years. And man, you've had some just crushing financial blows. You've already tapped into your cash value in your policy. You've already done some of these different things. You really just don't know what the future is going to look like. Somebody's got a bad prognosis for a really horrible medical condition. You just don't know. You just don't think you can pay premiums anymore, and you'd like to get this off your plate. Well, you might think, okay, I'll cancel the policy. Don't do that. There's no need to do that. This is what you do. There's an option after your policy has been paid for 7 full years. So in other words, at the beginning of the 8th policy year, you will have an option called Reduced Paid Up, or RPU, as it will be shown on documents sometimes. Reduced Paid Up means that they will see how much death benefit your current cash value will cover. In other words, you're going to take a one-time reduction in the death benefit, not a reduction in cash value, a reduction in death benefit, and then from that point forward, no more premiums. This is a double-edged sword. No more premiums may be paid in, but no more premiums must be paid in. So in other words, you cannot take your policy into reduced paid up status and then pay PUAs. It's not an option. Once you exercise this right, it's over. Your policy will continue to earn dividends as dividends are paid by the insurance carrier. Those dividends can grow the policy by buying paid up additions, but you may not pay any more paid up additions out of pocket. So it'll more or less just kind of do its thing for as long as you or the insured person live. You just can't grow it any faster than that. You don't have as much control over the future of the policy if you exercise this option, and it's irreversible. But it is there. And so this is an objection I see particularly on social media. People say, well, what if you can't pay your premium? You've got these huge premiums. You're asking people to put all this money into these insurance policies. I'm not. I tell people I don't care how much you want to put in your policy. I don't care what your premium payment is. It doesn't matter to me. I want to find the right amount of premium for you. And what often happens is when someone has a very, very small premium, they've really kind of backed off of the idea and they want to try it, but they don't really want to go all in. They typically come back and open another policy pretty soon, because then they get it and they start using it and they say, wow, I got to get more of these. So, I take directions from my clients. The clients are the boss, not me. But these are your options, and you've got a lot of them. So again, what is your option whenever you can't pay your mortgage payment? What is your option when you can't pay your car payment? What is your option whenever you are up against a wall financially and you're dealing with a bank? Well, it depends, but it may not be pretty, and you may lose something. The collateral on a car loan is the car. The collateral on a home loan is a home. Those things can be seized by the bank. The collateral on a policy loan is the death benefit. That means that some of the death benefit on the policy might not be paid to your beneficiaries if you pass away while you have a policy loan outstanding. It doesn't mean there's no death benefit. It means there's a subtraction problem. If you've taken a $5,000 policy loan and you have a death benefit of $150,000, it's $150,000 minus $5,000. Your beneficiaries still receive $145,000. It's very straightforward, and there's no seizing of assets involved because the collateral is an asset that the insurance company's already got. They're already managing this for you. It's a completely different lending environment, and you are the one who benefits the most from this arrangement, not the insurance company. And this is why sometimes I call whole life insurance policies the most powerful financial tool on earth. Thank you so much for watching. I hope this video helped. If you'd like to speak to our team to answer your personal questions to see how this might apply in your unique circumstances, reach out. The link below will take you to our booking page where you can find an agent near you, and we can have those conversations to help you see the implementation of the infinite banking concept in your life, including all of the potential downsides. What if I can't pay my premium? These kinds of questions. That's what we're here for, to help you understand what you're shopping for. You'll also find a link below to my book, Between the Lies: How to Reclaim Your Future from the Banks and Wall Street. It's available in print, digital, and now audiobook, narrated by me. Thank you again for watching, and we'll see you in the next video.